So today we're going to do three things. First, I want to clarify the difference between growth and value. Second, I want to walk you through the 8 key drivers of company value. And then third, I'll give you a simple challenge in each of those 8 areas so you can take action right away. Welcome back to Beyond Your Books, a small business growth podcast. I'm Mark Tuggle, CEO of Telos Bookkeeping. And today we're going to talk about something I see small business owners miss: the difference between growing your business and increasing its value. Growth is great, but what if it's actually holding your business back? Most small business owners measure success by growth: more sales, more people, more locations. But here's the twist. Growth and value are not the same thing, and if you focus on the wrong one at the wrong time, you might be running faster in the wrong direction. Now, growth is exciting. Bigger teams, more customers, more revenue. That's what we're supposed to want, right? But here's the truth. More revenue doesn't always mean your business is more valuable. And if your end game is freedom, maybe selling your business someday, those two things can actually work against each other sometimes. Big business can get away with that kind of growth. I saw it when I was at Oracle. They'd acquire a new company, lay off a bunch of people, and voila, revenue growth. A small business cannot afford to operate that way. An owner who starts chasing shiny objects instead of building an irresistible core is not building a valuable business that's going to sell for top dollar. Business value isn't about being the biggest. It's about being the most desirable to the right buyer. And there are 8 drivers of company value that tell us exactly where to focus if we want a business that's worth much more tomorrow than it is today. So today we're going to do 3 things. First, I want to clarify the difference between growth and value. Second, I want to walk you through the 8 key drivers of company value. And then third, I'll give you a simple challenge in each of those 8 areas so you can take action right away. So let's first talk about the difference between growth and value. Growth is like horsepower. It's exciting. It feels powerful. Value is more like torque. It's what actually moves you forward when it counts. Many entrepreneurs chase revenue growth without asking, will this make my business more valuable to a buyer? If you're adding product lines or chasing every possible customer, you might be diluting the very thing that makes you attractive to a prospective buyer. Think of Michael Lieberman and his company DataStay. He built product lifecycle management software for brake manufacturers, and only brake manufacturers. He became the guy in that space. When Autodesk came calling, they offered him 10 times revenue for his 9-employee company. He resisted the temptation to branch out, focused on one niche, and sold his 9-person company for 10x. That's the power of value over blind growth. Now imagine if he'd diversified into a bunch of other markets just to grow revenue. He might have looked bigger, but he would have been less valuable to Autodesk. Value isn't just about top-line revenue. It's about what makes your business transferable, predictable, and irresistible to a buyer. Strategic buyers, the folks who usually pay the most, pay for what they can't easily replicate. They want the one thing that you do so well that it would take them too much time or money to recreate it. So what actually drives up the value of your small business? Through the Value Builder system, we've identified 8 key drivers. I want to move through each driver with a quick story or example and a challenge for you. But before I do that, let me provide them to you in a quick list with a definition. The first driver is financial performance. This is proven profits and clean books. The second is growth potential, your realistic growth rate in your current model. Third is Switzerland structure, not being overly dependent on one customer, supplier, or employee. The fourth driver is valuation teeter-totter, positive cash flow versus draining resources. Fifth is recurring revenue, predictable income streams that buyers love. Sixth is monopoly control, clear differentiation from competitors. Seventh, customer satisfaction, measured by loyalty and referrals. The final driver is hub and spoke. Your business can run without you. Now, let's dive into each one in more detail. We'll start with financial performance. It should come to you as no surprise that financial performance is a key driver for value. It's your track record of generating revenue and profit. When you pair it with clean, professional books, you set a solid foundation for value. I was just speaking with an M&A professional last week who had just returned from a national conference for merger and acquisition professionals. He told me their number one complaint was the state of sellers' financials. In most cases, these were potential multi-million-dollar deals, but the consultants could not assure their prospective buyers that the financials were true and reliable. So it's not enough to truly have positive financial performance. You need to be able to present those financials in an organized way that engenders trust. Deals can and do fall apart because financials are messy. Owners can have strong profits, but if their record keeping is inconsistent, buyers may pass them up. Buyers don't just want to see the numbers, they want to trust the numbers that they see. So here's your challenge. Schedule a financial clarity session this month for yourself. Review your P&L, your balance sheet, and cash flow for trends. And if you wouldn't be proud to hand them over to a prospective buyer tomorrow, it's time to work on fixing that. The second driver, as I mentioned, is growth potential. Buyers pay for what they can grow, but it's future growth that excites them, not past growth. Ask yourself, could my business expand into new markets, products, or geographies? Here's the key, without me having to be there every step of the way. If the answer is yes, you've got growth potential. And different kinds of growth come with varying degrees of risk. For example, the safest play is to sell more of your existing products and services to your existing clients. But that might not be an option for you. On the other end of the spectrum, the biggest growth risk would be to offer new products and services to an entirely new customer base. It's high risk because it's untested for you, both on the offering side and the target side. Your challenge is to identify one market or customer segment that you're not serving today that could be a logical, scalable fit for your business. The third driver is Switzerland structure. Switzerland is famous for being neutral, not taking sides. And that's the idea for this driver, not playing favorites, if you will. If your business is too dependent on a single customer, a single employee, or a single supplier, your risk and the buyer's risk goes up. Think about what happened to multiple industries of consultants, lobbyists, and other vendors who serviced the federal government in Washington, D.C. almost exclusively. DOGE comes along, and suddenly their client base has disappeared. The agency who was their bread and butter is now gone or severely scaled back. That is a stark example of the negative consequences of not considering your Switzerland structure. Here's a challenge for you. If your top customer is more than 15 to 20% of your total revenue, make a 12-month plan to diversify. The next driver is valuation teeter-totter. Is your business a cash generator or a cash drain? Buyers love businesses that produce surplus cash. Owners do too, as a matter of fact. But now it is true that some businesses, and I'm thinking seasonal businesses, lawn care, snow removal in some parts of the country, had significant seasonal ups and downs. In college, I worked for a florist. I was the delivery guy. Valentine's Day and Mother's Day combined for more than 50% of annual sales. So, depending on your industry, this driver can be more of a challenge than other drivers. However, even in industry like the floral business, There are things an owner can do to generate consistent positive cash flow. Here's your challenge on the cash flow driver. Calculate your operating cash flow for the past 12 months. If it's negative, find one expense you can cut this month without hurting revenue. The fifth driver is recurring revenue, and this one is magic. Recurring revenue models command higher multiples. Think memberships, subscriptions, or service contracts. Dollar Shave Club sold for 5x revenue. I just mentioned the floral industry. A couple of software engineers bought a florist in New York. They saw that 30 to 50% of the fresh flowers were going to waste. So they launched H Bloom, a subscription-based floral delivery service aimed at businesses such as hotels, restaurants, and spas. Clients could schedule weekly, bi-weekly, or monthly deliveries. In moving to a subscription model, they did three huge things to increase their company's value. First, moving to a recurring revenue model with those subscriptions. Second, the same model allowed them to predict their usage, so wasted flowers dropped from 30 to 50% down to only 2%, saving them big dollars on the expense front. And third, they now had a scalable model that they could replicate in other major cities around the country. The result? Massive growth and increased value that resulted in $18 million in outside investment in their company. Here's your challenge. List your top 3 products or services. Circle the one that could be turned into a subscription or contract and start testing it. The sixth driver is monopoly control. Now, before you throw out your objections that your business can't be a monopoly, I concede, hey, I own a bookkeeping firm. Many businesses view that as a straight-up commodity, outsourcing it to the lowest bidder. I understand. But this driver is not about having a blue ocean product or service that allows you to own an entire market. It's about differentiating yourself from your competitor. How well differentiated are you? If you look like everyone else, buyers can just build a competitor. I differentiate my bookkeeping by focusing on my client's purpose and then building the reports and dashboards that align with that purpose. Once I customize the reporting, I offer value-added insight and regular business advisory services as valuable and differentiated add-on services. How do you differentiate your products or services? Here's another differentiation example. Take the company Stelligent. They started as a general IT consulting firm, and then they doubled down on one thing, becoming the AWS specialist. That focus made them irresistible, and they sold for about double the typical consulting multiple. I'll give you one more. I have a friend who's built a Zendesk implementation company that was named Implementer of the Year for 2024 in the US. His differentiator is the way he does business. He and his team live out a set of values that make them stand out. I actually hope to have him on the podcast soon so you can hear his story firsthand. Here's your challenge. Write down your number one differentiator. If you can't explain it in one sentence that makes a customer say, I can't get that anywhere else, refine it until you can. The seventh driver is customer satisfaction. Happy customers buy again and refer. Now, as a PhD nerd, sometimes I like to scrutinize statistics and claims pretty thoroughly. This is one that I have researched. I've read the white paper, I've reviewed the numbers, and this is the facts. NPS, Net Promoter Score, is the number one predictor of future revenue. That's why it's the gold standard for measuring customer loyalty and satisfaction. That's why prospective buyers will pay a higher multiple if your NPS exceeds industry standards. So use the Net Promoter Score to measure your customer loyalty and satisfaction. Here's your challenge. Make a plan to get NPS feedback from your customers or clients. Even if this week you simply call 5 customers and ask this, on a scale from 0 to 10, how likely are you to recommend us to friends or colleagues? You want to track the promoters, the 9s and 10s, and learn from your detractors, those who give you a 0 to 6. The eighth and final driver of company value is hub and spoke. Hub and spoke is one that most small business owners struggle with the most. Think of a bicycle wheel. It has a hub, and all the spokes that make the wheel stable and perform connect to that hub. Without the hub, there's no functioning wheel. Are you the hub in your business? Have you built it in such a way that it can't run successfully without your involvement in nearly every aspect of its performance? If you're the hub and everything runs through you, buyers will see too much risk. Even in businesses where you have an expectation of reliance on the owner, say a dental practice, for example, there are ways to reduce the hub effect. Let me give you 3 dental scenarios to illustrate my point. Practice 1. Dentist owner works 5 or 6 days a week, does dental surgeries and procedures, and his own books, and sometimes answers the phones, and sometimes cleans the office, and sometimes bills the insurance company. Practice number 2. The dentist works 3.5 days a week, only does dental procedures. She has delegated out or hired staff to do everything else in the practice. Practice 3. The dentist no longer practices dentistry at all. She runs a multi-million-dollar practice with contracted dentists and hygienists. Her job is running a profitable practice. In each example, the owner is less of a hub and the value of the practice is greater, not just in raw dollars, but in multiples at valuation for sale. Here's your challenge. Identify one thing that you do daily that someone else could do, say 80% as well. Train that person and step back. Shifting from a growth mindset to a value growth mindset can be challenging. Remember, growth, though, is a means. Value is the end. It's the telos. If you grow the wrong way, you can end up with a bigger, more exhausting job, not necessarily a more valuable asset. But if you focus on value, you get freedom, options, and the ability to step away when you want. So don't just track sales and expenses. Track your recurring revenue percentage. Track customer satisfaction. Track owner dependency. These are the levers that drive value. Owners who master these drivers aren't just building profitable businesses, they're building sellable ones. And here's the best part. Even if you never sell, you get the benefits. More freedom, more predictability, more resilience. The Value Builder system was designed to give business owners language and tools for making the shift and transforming their business. A key factor in making that shift is measuring what matters. A Value Builder assessment is a great place to start. The average business scores a 59 out of 100. But owners who raise that score to 80 plus get offers that are 71% higher than average. And here's the kicker. Most businesses can do it when the owner commits to working on their value drivers just 3 hours a month. So here's my final challenge to you. Ask yourself, if I took 3 months off, would my business keep running or fall apart? Would it still be worth the same, more, or less? And then pick one value driver and start improving it this month. Because your business can be more than just a paycheck. It can be your ticket to the life you've always envisioned, your telos, a dream realized. Not all growth creates value, but all value attracts opportunity. Growth is exciting, but value is what gets you free, gives you freedom to choose whether to keep running your business, pass it on, or sell it for a premium. Thanks for watching. If this episode sparked ideas or brought value to your journey, hit subscribe here for more insights that empower small businesses to thrive with purpose. Dive into more episodes here to keep learning, growing, and making an impact. See you next time.